Welcome back, everybody, to the weekly market analysis. I'd like to take a moment to remind you to subscribe to this channel if you find the content is helpful, and you can also follow me on Twitter at Mr. J. Thomason, and I post there pretty frequently. You can also find my weekly newsletter at befinanciallyfree.substack.com. The first half of the newsletter is absolutely free. The second half is for paid subscribers. Although this, what you're looking at here, the number 68, I specially published that free for everyone. So if you go to the link in the description below to the newsletter, you can look at this absolutely free, the entirety of the newsletter and all the things that my paid subscribers get to see on a weekly basis. So here we are. It's been a couple weeks. I didn't get a chance to update last week, but we're looking at the markets, S&P 500 having declined. If we go from the July 26th intraday peak, then it looks like we're down about 2.8%. So that was actually not reading from the right spot. So closing today down a little over 3%. So it's not a very big decline on the S&P 500 right now. The Nasdaq, I believe this drop is a little over 6% now. So that's a little bit more substantial there. That's probably the tech being unwound. The Russell from its top is down a little over 4%. The Dow kind of more choppy to the side, closing up today, down, but down over the last 2 weeks, down 1.3%. And so none of this is really a surprise for me. I want to go look at a couple of things that I tweeted. This was from July 14th. I posted, I think this was a Friday. Let me go back to my chart really quick. July 14th. It was a Friday. It's where the vertical line is on my crosshair. I made a tweet that said, I think that the long-awaited correction starts in the next 2 weeks. Somebody asked me why. And what I shared here, wow, that didn't mean to do that. A couple of things that I had noted back then. I can't really retroactively look at this with my charts and things like that, but I wrote that it was more of a qualitative view. Equities were overbought and the dollar was oversold. You might recall, if I go to the DXY chart, that right around that time we had just waterfalled down pretty substantially. So I wrote that the percentage of stocks above their 200-day moving average is at levels where markets sometimes have near-term peaks. So if we look at those market breadth indicators, so the stocks above their 200-day, we were looking at. Oh, I must have mistweeted that. So that was right around here. I think I might have meant the 50-day moving average, because this is the chart that I was looking at. So we're getting right around July 14th was right here. We peaked from that level just a week or a week and a half later, and then have kind of waterfalled down since then. Right, so this is the 50-day moving average, is kind of a more near-term, like near to medium-term momentum indicator, and so that I'm actually looking for that. I'm looking to see if it will kind of like sit right here around the 50 level, or if it's actually going to come down to below 20, close to the 10 level, which is where it's been on a couple of occasions right before bounces. But I'm not really sure about that. So definitely meant the 50-day moving average. I definitely mistweeted that. Sentiment was much more positive. So the perma bulls were running victory laps at this point in the S&P 500 and in tech, especially if we just take a look at the Nasdaq, where the Nasdaq was at on July 14th. So let me go. Let's see. July 14th was right here. The Nasdaq closed at 15,694. Which is 400 points higher than it is currently right now. And so, if we go from the beginning of the year, by the time July 14th happened, the Nasdaq had already been up 44%. And then if I don't have it up right now, but if I had my data charts up and I was showing you the sentiment, the bull-bear spread, was in like the 93rd percentile of bullish sentiment. advantage over bearish sentiment. And so that was just a few things. And some of it is what I wrote here was a gut feel. And at the time, all my quantitative signals were saying that staying long is safe. But that's obviously, we only know that they're corrections and that they're obvious after they happen. So I want to mention that I tweeted that because the NASDAQ correction, technically started only like 3 trading days after that. Whereas the S&P, I was the 2-week calendar day mark, I was off by like 3 days on that before the S&P 500 started to correct. So I just wanted to call that out because I think that that's really important that I was pointing out. We were just way too extended up here. We were due for a correction. I mean, look, the S&P 500 hasn't touched the tide line since May 23rd, May 24th-ish. The NASDAQ, it's even crazier. The NASDAQ hasn't touched its tide line since the tide cross happened back, in March, right around the time of the regional banking crisis. We were close in end of April and early May, but didn't quite get there. So this is kind of a natural place. It's been so extended for so long. I've been looking for this to come back, and then also if you draw this trend line from early January, connect it to around mid-March, and then late April, then you clone that trend line up, you actually get 3 perfect touches. A touch on February 2nd, another couple of touches on June 15th and 16th, and then some touches on July 18th and July 19th. And so it's a pretty natural spot. This kind of like area would have been a natural spot to kind of take some short entries, stuff like that. So all that is to say that it's no surprise that the markets are coming off a little bit from here. But the question is, what now? Is this going to be something that materializes into a bigger waterfall? And you have people on Twitter that are talking about a potential crash. You have others who are kind of perma bulls right now who are yelling at you to buy every single dip. So the question is what's going to happen going forward? So we're going to try to pick some levels to look at because I actually think that we are going to get another move up to the upside. In fact, not this newsletter from the 6th, but if you go to my July 30th newsletter, one of the things that I talked about, I should have pulled it up. Let me see, actually. I think I can pull it up right now. I want to pull it up from my key takeaways. Now, this is normally a section that is reserved only for those who are paid subscribers. But I want to point out right here that as we leave July, which is historically one of the strongest months of the year in equity markets, seasonality favors cooling. That's seasonally true. Likely to be triggered by a strong jobs report and then unfriendly CPI data. Now, the jobs report meant that, or was actually still good. So obviously, like, not this whole analysis is not correct, but there's something I want to point out. That I say if a market pullback or correction has not happened by the time the July CPI data is released in August, I believe the catalyst will come with said CPI data. And the reason I'm pointing that out is that part of the analysis for me was if we look again at the fact that price has just gone so far so fast, that if we didn't get a pullback like to the tide line on the S&P 500, then it was likely that the CPI data was either going to be bad enough to cause markets to start to react and get worried about inflation again, or all of the good news and upside would be priced in, so the CPI would actually end up being a buy the rumor, sell the news event. And actually, if you look at the candle on the S&P 500, it was actually a really strong up day. We opened at 44.93. We went up about 50 points on the session on the S&P 500 and then ended up closing down, ended up closing at basically unchanged, which is pretty crazy to think about. And on the NASDAQ, it was even crazier. We opened at 15,202. We were up 240 points, and then ended up actually closing barely down on the day. Excuse me. So all that is to say, I was actually watching for this week to be, if it wasn't already correcting, to be a catalyst for going down. And basically, excuse me, everything that's happened this week has kind of served again to fuel more and more of that. So the CPI data, today's PPI data, the inflation expectations and all that, nothing's really been able to keep the markets up. And when positive news events are not able to produce a good market reaction, or if the good market reaction gets sold off, then obviously that means that something bigger is brewing, and I don't like to ignore that kind of a signal. So I do want to mention that as well. Another thing I want to point out, as far as it relates to that, kind of one of the canaries in the coal mine was on August 1st. I tweeted this saying it would not be good if the Russell breakout was a fake out. So if we take a look at the Russell chart, I've actually had this trend line, this top trend line, since this peak came in. Just a few days after this peak came in on February 2nd and February 3rd, drew this trend line over. And we came up and we tested it, didn't break it, came down, kind of messed with it a bit. And then we popped above it, right, on July 31st, and then started to sell down below it on August 1st. And then we ended up still closing above it. But then we've come down since then. So that's a fake breakout. So exactly what I was talking about, it would not be good if the Russell breakout was a fake breakout. So, prices, it has been coming off ever since then in the Russell. And so there have been all of these different signals. And so I'm just pointing out the fact that there were a lot of signals that were pointing to a possible correction, and more things were being stacked in their favor. In fact, going back to my newsletter, one of the things that I talked about, let me go to my recent one because it's free for everyone. One of the things that I've been kind of wrestling with here is that the potential for upside because of net short positioning in stocks relative to historical standards, the probability of continued upside surprises in both growth data and earnings reports, which we are seeing pretty consistently, performance chasing, high probability, path of least resistance to the upside, and then balancing that against, and this is where I get into like the fact that we have extremely bullish sentiment that is at levels associated with market corrections. Flows data that has suggested that investors are piling into equity exposures, and then the expectation of deflation, and then declining liquidity. And so all of those things on top of what we've been talking about were suggesting to me that a pullback had to happen at some point. Now, the markets can always stay irrational longer than you can stay solvent, but that is something I want to point out. We'll get to that in just a second. So let's look at some levels. In general, across the equity indices, I'm looking at first the tide line as kind of the first spot. And the reason why is if you go back to, if some people are saying, oh, we're in a bull market. If we are in a bull market, then let's look at the post-COVID bull market. And you can kind of see that in general, across time, the tide line was a place that price frequently pulled back or occasionally pulled back to. And then even more rarely so, it pulled back to the lighter control line. So we've got a couple of occasions of that happening. But you can just kind of see as you go up in the bull market, the tide line is where price liked to touch. And then during that entire bull market, after the bullish tide cross happened, the price only touched the control line twice before the bear market started, or in two areas, October 2020 and then October 2021, which that's interesting, the seasonality of October. That's going to be something I'm watching for. Whereas during like the bear market, price tends to go way above the control line on much more occasions. So That's why in this case on equities, I'm looking for price to come back to the tide line and catch support there. And that's going to be the first. That's going to be the first line of defense. If we don't hold the tide line, then we're going to probably test the control line. And then if we don't hold that, then the lower support trend line, which is drawn in here, is probably going to come into play, which right now, from where price is currently at, that line is coming in around 4,200. The tide line is currently sitting around 44.25. The control line is currently sitting around 4,300, a little bit more than 4,300. On the NASDAQ, same story, although I think what carries more weight is this channel that I pointed out, which is converging with where the tide line is at. So this is going to be a pretty important spot, and it's currently sitting right around just below 15,000. And so about 100 points below where we're currently at is where I'm going to be watching for support. That's going to be the spot to buy. If we break down from this trend line, then I expect price to come. Honestly, if you go by the rules of TA, then theoretically price, if it breaks this trend line, price should come down probably to about 33 or 13,300 or so. But I'm not calling for that. I don't think it's going to be that deep of a correction here. So first place to look at is about 100 points below, just below 15,000 on the NASDAQ. And then the Russell, a little bit different on the Russell. I'm looking for price to either catch the control line or come just below the control line. So looking at between 1875 to 1850. And if it continues, then I'm looking for it to catch the bottom trend line from this kind of like sideways consolidation that it's been in. And the Russell is a little bit different because you can actually see there was another sideways channel that we had to pay attention to back in 2021, right? It was kind of just like this little channel. And so we've got that same kind of a situation happening here during this period of time, although it's more of a sideways triangle, not so much of a channel, but you can kind of draw a similar sort of a thing just like that. So with that, that's why I'm kind of watching more of like the lower trend line if the control line doesn't give way. The dollar. Yeah, so again, like the dollar, this is that spot where, I called out that the dollar was oversold. It's been basically up since then. This is a spot that I find very interesting because we've got now the tide line is turning green at the end of this week. So it's a bullish counter trend, as we might say. And the tide and control line are starting to curl up. And what I'm going to watch for is if we can get this tide line to come up and make a cross. Price, it's probably going to take at least 2 weeks for this to happen, so you have to respect the x-axis here, unless we get some really solid, strong price action to the upside on the dollar. The other alternative viewpoint is that in every situation in 2023, when the dollar has come up on the opposite side of the control line as the tide line, that's been a place to sell. It's happened, it's happened here, it's happened here, it's happened here. And so is the fourth time going to be a charm, or is this time going to be different? The highest probability is that the dollar is actually going to sell down from here. So if this is something you're interested in doing, then what you do is you set the trade that if price falls down below the low of this wick, you set the entry point, and then the stop loss would either be at the top of this, like right above the high of this candle, or you can go above the high of the candle from July 5th, which gives you a little bit more room, but obviously lowers the risk to reward. But this is a situation where you have clear risk management here. And the dollar is going to have a lot to say in where equities go, because if the dollar continues to break to the upside, you could probably expect that equities are going to drop. Whereas if the dollar starts to come off, then equities will probably recover pretty sharply. Now, I want to talk about the bond market really quick. So this is the 10-year. We're above 4%. And like, gosh, if I didn't point out a bunch of times all the time over the last couple of years, all the places where everyone thought that bonds were peaking, like bond yields were going to peak and were going to come down, and all the different times, like I don't have it pulled up right now, but there's a tweet that I made somewhere over in this range, or maybe it was over here, where I was saying that I was feeling eerily similar to where I did back here in July and August of 2022, where everyone was like, oh, bonds peaked at 3.5%, and they're going to, at the yield at least, and they're just going to go down. And I was like, no, they're not. They're going to go to new highs, and they did. Kind of a similar thing that I was feeling right around those periods of time that I circled. And we're not that far from the all-time high. Or not the all-time high, I'm sorry, the last year's 2022's high. I think we're going to get there. Let's take a look at another bond chart. This time, instead of looking at the yield, we'll look at the TLT. The TLT bounced from an oversold condition, but it got super oversold at towards the end of last week, and it got a little bit of a bounce, but it couldn't even really truly retest the trend line from this sideways channel. The tide is extremely bearish. It's curling down pretty far. I think we got this little bounce because everyone was expecting that the October lows from last year are going to hold. I'm not so sure about that. I think TLT is going to go lower, and that has pretty strong implications for, I think, the stock market and specifically tech. We might see a bounce, but here's something I want to point out. I had this pulled up. The flows, I've actually been writing about this. I wrote about this in last week's newsletter. I want to say, let me see if I can find the flows really quick. Right around right here. Basically, for all of, I show it here for total bond flows, and then here I'm showing it for just TLT. All year, flows into bond ETFs, which means long bonds, short yields, have been extremely positive all year. And I've suspected that, though when you look at, aggregated positioning, let's see if I can find it. Like on this chart, which is from my newsletter, I have the 10-year treasury yield, which is kind of here in the bottom. It's in like the second percentile as far as futures positioning is concerned. So a lot of people were looking at that and saying, oh, it's bound to squeeze to the upside. Yeah, maybe, but like ETF exposure has been positive all year, and TLT exposure has been hugely positive all year. And up to this point in August, so far the flows have been negative for the first time all year. And so because of that, I actually think that if all of this like bond inflow starts to unwind, because think about why has it been positive all year? It's because the recession fears, everybody went into 2023 thinking recession, and that's kind of just been pushed back and pushed back and pushed back, and everyone has been counting on this recession to happen, and it hasn't happened yet, right? So what's happened now is a lot of people are starting to unwind those bond positions because they're being left behind by a NASDAQ that's up 40-something% on the year, and bonds have basically done nothing, and there hasn't been a recession. So all that to say, whether you go to the IEF, like the IEF, which is the 7 to 10 year, which is a good ETF proxy to the 10-year treasury yield, it's about to meet its October lows. If you look at more short-term treasuries, those are also heading down. If you look at TIPS, that's broken its channel, and it's near its October lows, right? The only thing that's not really behaving the same way is junk, which I think I saw a Real Vision interview where somebody was talking about this. It's really crazy to think that there's more demand for junk bonds than there are for treasuries, right? So I usually use the junk. Let me see if I can find the right one. The junk to treasury cross as a proxy for risk taking, and that has actually been generally tied positive, since mid-July, and trending that direction for a while. So I think that's really interesting as far as the risk taking in the markets is concerned. But all that is to say is I actually expect treasuries to go higher, and I don't know if they're going to do it right now. like if they're going to do it in the near term. I actually don't expect that in the near term. I think that treasuries will probably bounce for a moment, but I do think in the long run, all this, recession expectation has to get priced out. All the strength in the U.S. economy has to get priced in, and growth is bad for bonds, I would say, especially if inflation stays sticky. If growth is strong and you have you're getting good yield in a bunch of other things, you're getting good performance in a bunch of other things, there's not going to be a whole lot of demand for treasuries. The other thing that growth is not good for is gold. And this is something like, where did I call this out? I'm pretty sure it was like somewhere like right here. Everyone's getting all excited about all-time highs. Gold's over $2,000. And I'm like, no, gold's not going to make an all-time high in 2023. And, I got a lot of flack about that, but I hold that view. And actually, gold is trending to the downside. And normally this would be a place where you would buy, just like I was pointing out how on the dollar, when you get this price being on the opposite side of the control line as the tide line, normally that would be a place to buy or to sell depending on the direction. But in this case, we had a really weak bounce. I mean, what you typically see is if that buy below the control line was to come to pass, then you would see gold move up and make a higher high, just like it did right here, made a higher high. But it didn't do that. So the price of gold is actually weak. This bounce is weak. So I expect that this is going to make a lower low. I expect the tide's going to cross negative. And I'm actually looking for, at this point, price to at least test 1800 and potentially to go back down towards 1700, somewhere between 1700 and 1800 before this is all over. And I think over time, like that, I think that'll unfold across the rest of the year. And then once I do believe there's going to be a recession, then once the other side of the recession is happening, like I think that's where gold is going to make new all-time highs. So I've been saying, and I'm confident in this, gold new all-time highs is going to be a 2024 story. It's going to happen. The break of this, red trend line is going to happen somewhere in that range, okay, across that year. That's my current gold thesis, so I'm not buying into precious metals. In fact, if you were to look at GDX, right over here at the top of this spot on Monday, May 15th, the day after my newsletter posted, I had said that you should short GDX, and GDX as of today is, whoops, that's not the way I wanted to do it. GDX today is down 12% from where I said to short it. So just saying, you can get a lot of signals from my newsletter. The other thing I want to touch on is oil. So oil, we are now getting a tide cross. That's extremely bullish. The last time we had a tide cross was back in November of 2020, and price from there went from the moment that cross took place to the peak. Oil went up 200%. Now, remember, like nothing is 100%. So like we had a tide cross here in August and we pulled back for an extended period of time. In fact, from the moment of this tide cross, we ended up falling down as much as 21%. So it's not foolproof. We also had the same thing happen here. So it really just depends. But I do want to call out, usually the tide cross is a really, really strong signal, just like here to the downside. From the moment of this tide cross, price, by the time it hit its low, had come down 28%. So I want to call this out. Now, what's the level that I'm watching for? I think oil is going to pull back to about $78, $77, and that's going to be the spot where you want to take the long. That's just what I think is going to happen. I might be wrong. And then finally, let's look at Bitcoin. I wrote in my newsletter last week, I actually think Bitcoin is poised to go to the upside, but it has yet to prove itself. Now, one of the things that is wrong about this picture here with Bitcoin is that liquidity is not cooperating, right? So if you look at my liquidity chart here, obviously liquidity isn't the only thing to look at, but what I want to point out is the cyan line here is like a global ex-US liquidity. It's been heading down. In fact, it's near its lows from last year, while US liquidity at best has been sideways to slightly down. Had a little bit of a pop the last few days, but it's not improving on a material or substantial basis. And so with that being said, like liquidity is one of the best is one of the best things for Bitcoin. Bitcoin tends to follow liquidity. In fact, if I go back to this chart, it's not a coincidence that as US liquidity has gone sideways, generally so has Bitcoin. So just calling that out, it's not exact, it's not perfect, but it is a really, really big deal. So just wanting to point that out. And so, you know, like one of the things that's going to be really important is to watch this lower trend line on Bitcoin, which right now is, you know, it could line up pretty well. The trend line is currently in between the tide line and the control line. And so if price were to dip right down here, this would be a good spot to buy from a risk to reward standpoint. But you would want to be really, really concerned if it breaks this trend line. So this is the trend that has been intact since the beginning of the year, and obviously Bitcoin from the beginning of the year has come up 78%. So if you're long Bitcoin, you'll want to manage these levels pretty carefully. If you're trading Bitcoin, again, once you hit this trend line or come peak a little bit below the tide line or below the control line, that would be a good entry spot, because they don't actually happen very often. Especially, I pointed out, they don't happen often on the NASDAQ. They happen even less usually on Bitcoin. So like, let me go back really quick just to show you. I know I'm about 30 minutes into this video. We go to the last Bitcoin bull market. So the tide cross happens May 2020. After the COVID crash, right? And then you've got price going up, comes back, still doesn't touch the control line, and it doesn't until the bear markets, until the you know, the shenanigans with like Elon Musk and like all the FUD about you know, ESG and then China shutting down mining. Like, it didn't happen until then, right? That's a long time to miss out with Bitcoin. So if you get price down to the tide line, that's probably the best spot to buy, right? And then here, once we got the tide cross again, it happened one time before we got to the eventual price peak. So all that is to say, if you can get Bitcoin on any of these wicks below the tide line, or if you're lucky enough to get it below the control line in a bull market, like, man, like, good on you. And with that, I'm going to cut it off here. So hopefully it was clear to see what levels I'm watching, and just be careful over the next few weeks. I do think that price is going to come off across risk assets for a little bit longer, but I'm not anticipating it being the big crash credit event or thing that, you know, makes equities go down super far. I think we're going to get this dip and then one more good run to the upside before the main event happens later this year or early next year. So you have to respect the x-axis, and the beauty about my situation, or the situation for me and my newsletter subscribers, is that we have tools like what you see on the screen, like our tide line, and we have our indicators, which are keeping us out of these price declines, giving us small pokes, but generally keeping us out when price comes down. And if I pull back and show you across time, it's generally a really good idea to have something systematic that will tell you when to be in the markets and when to be out of the markets. And so with that, I'm going to wrap that up. And again, don't forget to hit the like button, subscribe to the channel, subscribe to my newsletter, follow me on Twitter, and I'll see you guys next week.